Welcome everybody on the home stretch here. Glad to be here. My name is Greg McCoach, the Mining Speculator newsletter. Been writing that now for 19 years, going into my 19th year. And I really appreciate this conference. People that come to this show at this time to me tell me that you are some of the most shrewd, sharpest investors out there, because only people that are smart enough to understand the undervalued nature of what we're seeing right now in the mining space. And I'm a big bull for what's coming in the near future, hopefully. So mining shares are weak right now, but monies are flowing towards expiration. We're seeing a lot of private placements. Money is coming into these private placements. The companies with the tight share structures and the good stories, really, it's happening. That's a good sign for me. Basically, the companies are real cheap right now. They're discounted to a large degree. While this is happening in the precious metal side, the metal prices are low. I don't know when the change in psychology will occur, but this mindless selling is a setup for a very large revaluation at some point. Although there is no timing in that statement, and one needs to manage the risks. If we knew the timing, we could all jump in. And in my opinion, the mining space is one of these deals now where you got to be in before it happens, because when it happens, it's going to be a violent change to the upside. What we're going through right now is one of the most extraordinary phenomena I've ever witnessed in my career of trading junior mining stocks, which is 37 years, 19 of which I said as a newsletter writer. The bottom line is that the computers and the algorithms are pushing in a certain direction, and the more that goes on, the more absurd the price becomes in these markets. But at some point, the trend in either direction does reverse, and the more the absurdity beforehand, the greater the reaction will be afterwards. So, my outlook, just briefly, where I stand on things, money flows are beginning to change. The volatility has started to show up. That's starting to tell people they might need to look elsewhere. That's a good thing. I think that will continue. It may not happen in the next few weeks or the next couple months, but it's by the end of the year, I think things are going to change significantly. Gold, where's gold price going to go? Without a catalyst, the gold suppression scheme that's been fully implemented now to a high degree since 2012 has kept a lid on us. And it's really an unfair situation, but it is what it is. So if we don't have a catalyst like a black swan event this year, I see gold maybe grinding a bit higher, and that's it. With a catalyst, we could have a major breakout, and silver would follow. Base metals, I'm big on zinc, copper, and cobalt. I think they'll lead the way in 2018 and beyond. Probably for the next 3 years, those are good base metals to be involved with. Uranium, I still think we're another year away. I like uranium. I'm saying to my clients who like uranium that you should look to buy the quality explorers, during the summer months when the stocks are still cheap, because that market will ignite at some point, but I think it will be next year. Mainly because Kazakhstan is the supply gorilla that just has so much supply that they can put into the market with higher prices. So I think that'll change in 2019. So I am a uranium bull in 2019. For now, the place to be is in the quality exploration companies that are active in the field, have the money to drill, they're aggressive about drilling, and I think that when the money is flowing again, new discoveries are critical right now because the majors need to replenish reserves. So as a newsletter writer, I'm only as good as my next pick for helping people make some money. And I think for 2018, you got to be with the junior exploration companies that are in the best mining jurisdictions, companies that have tight share structure and have the budget to drill aggressively. Best mining jurisdictions that I like, Golden Triangle. I'm big in the Golden Triangle right now. Yukon, Nevada, Ontario, Peru, and Mexico are my favorite jurisdictions. I put this slide in. I was just down at the Orlando World Money Show, and I had a 45-minute presentation. And I went into some topics that down for that crowd, they don't understand resources and why they should be involved. But I put this slide in there because for people that don't know me, I want them to know that I'm an optimist by nature, but I refer to myself as a pragmatic optimist. Why? Because I can't bury my head in the sand and ignore the obvious facts that are all around us that point to major trouble ahead. I hope for the best, I prepare for the worst. And I think the mining stocks, the undervalued mining stocks, are the place to be. The credit-fueled delusion. This is the title of my talk down in Orlando, and I'm just going to take a quote. John Embry, who's a local here in Toronto, I just saw this. I didn't have time to put it in my slide, and I wanted to just read it. Broke but full of hope, right? You know, there's all this hope, and these markets keep going higher and higher and higher, but they're bubble markets. And John Embry said the following: the powers that be are pulling out all the stops to make sure that sharply rising gold and silver prices don't reveal the absurdity of their monetary policies and the rampant inflation which is overtaking the entire global economy. One has to acknowledge the success of their plan up to now, but reality is beginning to intrude, and so I expect a violent upward revision in gold and silver prices shortly. Unfortunately, it will be accompanied by much higher interest rates, which will take a severe toll on an incredibly over-indebted financial system. John Embry. So, you know, we've got a lot of things to be concerned about. BTFD, this is a, you know, let me see, I want to go back one slide here. This one's out of place, but that's okay. I'll just mention this right now. The market, it doesn't matter what the news is, it only goes one way, up. And it doesn't matter whether bad news comes out, bad news is good news, and good news is good news. Doesn't matter. The market is all going one way because that's the way it's intended to go. Whether it's real or not, we'll soon find out. But I believe we're living in an unprecedented mania. First, as a trader, I'm finding it more and more difficult to figure out the drivers to these markets. That's what I always looked at over the years when I made my predictions about gold going from its low of $253 to $1,000 an ounce. People thought I was crazy. They thought I was a tinfoil hat guy, right? Greg the gold bug, right? You know? And, you know, I was taking a photo op. Somebody's taking a picture of me on this, but I just want to use it for the newsletter just because I'm criticized for this often. Yeah. Anyway, out of all the newsletter writers, you know, we joke amongst ourselves. Jay Taylor and I are probably considered the gold bugs, but we wear those labels well and we take the criticism all in jest. It's all fun. But anyway, two little points here. If you haven't read the book, Extraordinary Popular Delusions and the Madness of Crowds by Charles Mackay, I've read this book 3 times now, once just recently, and it just reminds me all the things that we're seeing and hearing in these bubble markets, it's all right in this book and explains why this is unsustainable, right? Another guy named Graham Summers, Phoenix Capital Research, he just did an excellent paper on the everything bubble, the end game to central bank policy. Very, very good. And if you haven't, I think you can get it for a small fee. It was online for a little bit, but it's a good read. Anyway, so as a trader, you know, these drivers, these drivers have always told me, been a telltale sign for me of things to come. Nowadays, it seems the very violent market swings have nothing to do with drivers anymore, but are a function of the fact that 90% or more of the trades are electronic algorithm program executions. It's almost like a feeding frenzy where one or two of these programs kicks in and volatility shows up in the direction the programs want to go. These programs can execute strategies faster than anyone can decipher the news, giving the institutional investor a huge advantage. And second, on top of this unnatural market situation, we must deal with the fact that the Fed has painted itself into a proverbial corner. In order to keep the illusion going that all is well, the Fed maniacs have flooded the world with so much liquidity that massive unsustainable bubbles have formed in numerous markets. The danger here is that these markets are no longer displaying reality. And interest rates, for example, have lost their natural and reliable steering function and signaling properties. They have been fully distorted by quantitative easing to infinity and left the Fed flying blind. Looking at the massive stock and bond rallies over the past decade, you would think we are in nirvana with natural economic laws being repealed. But, you know, we see, you know, supply and demand don't seem to matter in this equation. Debts don't matter, right? Money supply doesn't matter. Revenues and profitability no longer matter. Good news is good news, bad news is good news, right? It doesn't matter. This market doesn't seem to have any logic or sense to it. And so I'm saying that we are coming to a point where this is going to change. So anyway, so where things stand. So it's not a secret that central banks have been funneling liquidity, both directly and indirectly, into stocks. But the liquidity pump is about to end, because the endless stream of liquidity, which has been 100 to 110 billion a month since 2009, do you think wherever that money goes, of course it's going to cause a bubble in those markets, and it has, and people need to understand what's caused this. It's not that these companies have done so well, it's that there's so much money in the system chasing after so few stocks. But this situation has finally begun to unleash inflation. We got the first whispers of this, and we'll talk a little bit more about that. But look at what just happened in the bond markets, which trade based on inflation in the real world, not what you hear from the massively deceptive media. So here's the big 10-year U.S. Treasury yield. This is the chart showing that a 20-year trend has now been broken. For the first time, this line is going above the red line over a 20-year period, and it says inflation is coming. This is the first wake-up call that something's not right. Okay, same thing with the German Treasury bond and the Japanese Treasury bond as well. The yields are going up. So if bond rates continue to rise, many countries will quickly find themselves insolvent. Why? Well, globally, the world has added over 60 trillion in debt since 2007, with massive interest rates based at or close to even below zero. So what's going to happen if interest rates rise? If they can't pay the interest on their current debt now, how's it going to be with higher interest rates? It's just not going to work. So central banks cannot and will not risk blowing up this debt bomb. Okay, so what are they going to do? This means, in my view, central banks will be forced to pull the plug on liquidity and let the stock market go. The Fed is caught between a rock and a hard place. We'll have to decide, one, to let stocks drop and deal with the aftermath, or let the bond bubble blow up, destabilizing the entire financial system and rendering most governments insolvent. They're not going to let number two happen. They'll opt for number one. They have to. So in the bond world, see, this is where all the liquidity that most people don't understand, it comes from the bonds. And I believe it's the bond vigilantes that are going to put an end to this, because they're coming to the point now where they realize they can't get paid back. So they're not going to do this. They're not going to play this game anymore. So I think it's the bond vigilantes, as I call them, that are in the process of giving these markets a dose of reality. But why are the bonds so important? This is something that people, I don't think, really understand. In 2008, central banks attempted to corner the sovereign bond market via interest rates and QE programs, right? Everybody heard quantitative easing, right? In our current financial system, which no major currency is backed by gold or any other finite asset, sovereign bonds represent the bedrock of the current system. They are the risk-free rate of return, or the standard against which all risk assets are valued. Put simply, central banks attempted to corner all risk by controlling the baseline against which it was valued. So this created bubbles in literally everything, and is the idea that investing comes without pain and was the equivalent of a free lunch. Central banks created a bubble in the risk-free rate of sovereign bonds. A bubble in stocks and money was forced into risk to find higher returns. Number three, at the end of the day, the entire move in stocks since the great financial crisis of 2008 was based on the Fed creating a bubble in sovereign bonds. Bonds trade on inflation. So if inflation rises, as we're now seeing, so do bond yields. And when bond yields rise, the bond prices fall. Thus, when bond prices fall, the massive debt bubble, the bubble that fueled the move in stocks, begins to come undone. But the majority of voters don't seem to care about any of this debt issue and these bond issues. They keep electing the same spendthrifts to office. Look at the last three presidents in the United States, the Clintons, the Bushes, the Obamas of the world. The debt doubled every year during their tenure. Where's Trump going to go? 20 trillion to 40 trillion? That's the trajectory we're on in the United States. As an American citizen, I'm concerned. But the problem is, deep down, the masses know that they need massive amounts of government debt to pay their Social Security checks, Medicare, and disability, right? They have to keep creating more debt, or else we're not going to get paid. These promises can't be kept without all this debt. So it's a very sensitive issue. We have come to the time where the debt must perpetually increase or the whole financial system breaks down, okay? As I say, you can't print your way to economic nirvana. Debts do matter, and the people are going to find out that this has a limit. And when that exact moment is, we don't know, but I think we're getting close. The debt in the United States is such an absurdity at this point. The federal debt has grown at such a rapid rate that standard dollar units no longer describe what's actually going on. So to use a little analogy, the debt numbers are so large it's difficult to distinguish between hundreds of billions and trillions. Taking the speed of sound as a comparison, when Chuck Yeager first outran what was called the sound barrier at Mach 1, that was 767 miles per hour. So at over $34,000, the United States is spending new debt every second. The federal government is running up the debt at a speed that's over Mach 30. That's insane. That's total insanity. That's unsustainable. The national horror, right? And it's not just the United States. It's every country in the world has this. So this chart is a scary chart to me. This really tells it all. The red lines up and down. Where's the pointer on this? Yeah, the red lines. These, okay, you see those three lines, right? This is the divergence of what happens between consumer confidence and savings rate. When you see those two lines diverge dramatically, guess what happens? Crash, okay? 2000, the first one on the left. The middle one, 2007 and 8. Look what's happening right now as we go into 2018. Big divergence, okay? This is crazy. If you go back and look at all historical crashes, 1929, 87, 2000, 2008, they all displayed the very same volatility we are now seeing. You know, it's the first drop, then the dead cat bounced back up, you know, and people think, oh, we're okay, but then you have the collapse. It looks like we're coming to this. Something is coming. I can't say exactly when it's going to be, but it's definitely coming. I have a big fund manager that I've known for years. He manages over $300 billion. And he said, we were in a conversation with some very shrewd guys, and they were asking him what he thought about the markets. And he said, markets? What markets? These aren't markets. This is all orchestration. There's nothing left of free markets. He said a lot of hedge fund buddies he knows are getting out of the business because they can't compete with the algorithms. They have such an advantage, they can't do it anymore. The illusion that all is well. The real data says otherwise, right? The government wants you to believe, hey, everything's great, right? But the data really is not. 72% of U.S. workers living paycheck to paycheck and strapped with enormous credit card debt, the biggest record in credit card debt in the history of our country. Just happened in January, just got reported. 49% of Canadians in the same boat. Canada is doing better than America in many ways. The massive credit expansion has created insane wealth for the minuscule elite. Less than 0.7% now own 45% of the entire world's wealth. With the people, the masses are strapped with massive debts and stress. 8% now own 85% of the wealth of the world. And those numbers are going in the wrong direction. To have a good society, a solid society that's moving forward, you have to have a balance. The middle class has to be doing well for society to survive. That's not happening anymore. So I'm watching for catalysts. I only got a minute here, so I'm going to wrap up. A lot of craziness going on. A lot of promises are going to get broken. Governments have made all these promises. In the U.S., they have $104 trillion of promises to pay, and they have no money for it. Where's the money going to come from, right? Lots of promises are going to get broken. People are going to be it's going to be bad, unfortunately, you know. Look at the state of Illinois. Crazy debt they can't pay, right? They raise taxes dramatically, they won't even dent it, right? So what happens? I believe the state of Illinois will be the first U.S. state bankruptcy in the history of the American government. Crazy. Anyway. So gold and silver are building massive bases, and I think you're going to see much higher prices. But I'll skip some of these slides. If anybody wants this, I'll give you an email address. I'll send you the whole presentation. But when confidence turns and fear returns to markets, sometime between now and probably 2019, gold and silver will surge in price. These mining shares are going to go with it. I believe we are about to see massive changes in the money flows. As people see and feel these changes and the fear, it's going to come flooding into our market, this tiny little asset class called physical precious metals and mining shares. I believe we're going to experience the greatest bull market in mining shares and precious metals we have ever seen in our lifetimes. It's coming. I can't say if it's this year or next year, but it's close. Now's the time to be buying these shares. The lesson here is take profits in overvalued assets, be they crypto, stocks, bonds, or property. Sell overvalued assets and buy undervalued assets. Rebalance investments and diversify into undervalued assets like gold, silver, bullion, precious metal mining shares. Marigold, I own a bullion dealership out of America, if anybody's interested. And subscribe to the Mining Speculator, my low-price newsletter for only $99 at discoverynexus.com. If you want a copy of the presentation of Marigold at msn.com. Thank you for listening.